Good morning, everybody, and welcome to the ARMR Report. This is our weekend edition. Thank you all for joining. If you have any questions, feel free to fill out the comment section as I go. I'll get to the answers later. And of course, if you watch this later in the weekend, comments down below. I'll be happy to answer you when I can. So this is the ARMR Report. I'm Brett Rosenthal. This is about stock market investing, and it stands for Algorithmic Risk Management Research. And we're going to talk about risk management a lot today. Let's keep the agenda tight because then we have our ARMR macro meeting. We do it on the first Saturday of every month. ARMR Insiders, you can go to the Slack room, find the link to join us on Zoom so we could dive deeper into the big picture macro story. For the sake of this conversation, we're going to keep the agenda tight. We're going to talk about the risk monitor and the direction it's headed. We're going to talk about precious metals and reflect on the week and what it means for our positions, almost as a follow-up to last Saturday's discussion with the Silver Fox, which was a macro deep dive discussion into the structure of the precious metals market. But today I'm going to talk to you about how we manage capital and how we manage risk. Okay? So those two things can go together. They have to go together if you're going to be a successful investor. And then I'll get to some top shelf investing ideas, names that are on our whiteboard that we may have taken positions in last week, or maybe we'll do it next week, and we'll go through some charts together. And then I'll get to your questions. I am getting over a bit of a head cold, so bear with me. As always, this is a show about how I run my own personal capital and capital that I manage for individuals. The object here of this virtual hedge fund, which is what we're running. You're the portfolio manager on the virtual hedge fund desk right now. Take the information, decide how it fits your portfolio approach, figure out your risk tolerance, your goals, what you're trying to do with your P&L, and then run with it. Okay, so that's what you've got to do. That's your homework. I'm going to share with you the information that we develop on this desk, and then you take it and figure out how it fits your approach. All right, so I see Michelle is with us. How you doing, honey? Nice to have you. Thanks for joining. None of this would work without her. So let's dive in to the risk monitor first, because I get a lot of questions on the desk. As the market goes higher, will the risk monitor turn green? So let's address that right now. The risk monitor is yellow. It means we are cautiously putting money to work. It will not go green just because the market's skyrocketing. That doesn't make the risk monitor go green. The risk monitor is a combination of algorithms we've developed for 7 indexes that we think drive the whole market. I shouldn't say drive. 7 indexes that encompass the whole market. And our philosophy at the ARMR Report is that institutions make markets. What that means is for there to be a sustainable move over a series of months, what we all like to call a bull market, you need institutions to be moving in unison. Those are the elephants, on the Serengeti plain, I like to say. And when the herd is pounding towards the watering hole, we got to be the cheetah out in front. Make sure we're not getting stepped on. And so the risk monitor helps me do that. It's yellow right now. I'm going to show you why. We're going to go through charts. We're going to look at the 7 indexes. And then we've added, I think it's 4 more as secondary. We just started doing this on this last entry point. And I'm going to share with you these other 4 indexes. They're kind of supporting data, okay? But in order for us to get that green switch, which is what we all really want, that's when, sky's the limit. And you can get a sustained rally over a long period of time. You need the unison across, you need the confluence. So what you don't want to see is massive rotation out of leadership into stocks that have been destroyed. Those stocks skyrocket, so it looks like the market's starting some major uptrend. but it's at the expense of leaders. So what that really ends up telling you is you're in a washing machine market, and for a certain period of time, you can get a run in the market, but is it sustainable if the leadership's rolling over? Typically it's not, and that ends up being a risk monitor yellow. It means you can run through the legs of the elephants, but you better not get stepped on. You got to be cautious. That's what we're saying. Okay, so let's go look at the indexes and get a better feeling for what the market's doing by the end of the week. Because, I'm not going to preface it. Let's look at the charts together. I've been saying all week that, price action is all I care about. It's not the news. I'm not going to spend a second today talking about what the non-farm payroll number is. What does that mean? What did the Fed say? What was CPI? None of that helps anybody make money. All we have to do is follow price action. If it continues to confirm strength, we will stay long equities. The risk monitor won't go green unless one of two things happens. One, market sells off from here and has a correction, not big enough to ruin the market, but just a correction that sets the process in motion for all the algos to give us the next entry point, which will be a follow-on entry point. So you have yellow, run up, pull back, follow-on entry point that flips everything in unison, green. Boom. We'll go green after that sell-off, right? The other scenario is the market just skyrockets from here. Okay, goes up. We're going to make some money. And it will find a level at a higher area and consolidate. Could be a matter of weeks, could be a couple months, I don't know. And then come out of that again, and that will also reset the algos. So time or price resets the algos. Once you're in a move, the algos don't reset. We need a correction in time or price. And that's okay. Look, market goes up. We're going to be out there putting capital to work in a cautious way, trying to make some money. What does cautious way mean? It means that when we see something that we don't like on Friday, the action Friday was a little disturbing, we're going to book profits and things. We're going to raise stops. We're going to swing trade more in a risk monitor yellow market than we would a green market. In a green market, we have wider stops. We allow for more volatility, and we try not to mess with a good thing. In a yellow market, we say it's a good thing, but we're going to raise stops. And if things start to roll over, we're going to book profits quick, see what happens. Everything's steady. Okay. Put capital back to work. Try to make another move. Okay. Until we get the risk monitor green, or of course you could break down and the risk monitor turns red. And that's a whole nother argument. And we'll deal with that if we get to it. Let's go through the 7 indexes so you get an idea of what it looks like. So I have RSP up first. This is the equally weighted S&P. And you all may remember from a Saturday a few weeks ago that we had this discussion. I said, I've never used the equally weighted S&P as a guide. I always use SPY, which is the weighted index. But the equally weighted index is showing the most strength. And this is really what helped us go from risk red to risk yellow. Risk monitor red, yellow. We said, look, if the underlying index, the equally weighted index of all stocks is having a move like this, it was right in here, so it had just started to give us a signal, then there's got to be something bullish going on here. And then we could drill down and look at the equally weighted NASDAQ 100, and it was doing the same thing. So these are two of, and I'm kind of doing this backwards. I meant to show you the 7 first, but we'll see the 7 second. These are now added to our decision matrix, the equally weighted S&P and the equally weighted NASDAQ 100. It's almost another way of saying the breadth of the market was better than the bigger indexes suggested. As you can see, equally weights already above the 250 and extending higher. Excuse me. Now let's go to the 7 indexes. So Qs this week, Qs broke out above the 200-day, which is the green line this week, and are still locked inside of this sideways pattern going back to the first time the Fed got hawkish last May. That was the first real, we're going to crush, inflation comment. And so that yellow dashed line is important because with all the excitement out there in the market and all of the, will the risk monitor go green type of questions, if you look at this, the market's just going sideways in a base, waiting for the Fed to end its rate hike cycle. And it's going to test the Fed, and it's going to try to get above this level. But if the Fed remains steadfast and keeps raising rates, it's going to be hard for the market to do that. Price action is all. That's all I care about. If it happens, I'm ready to go. But risk monitor is yellow because the big indexes that are weighted, okay, have yet to break out of that pattern. This is the S&P now. Equally weight's already broken out. Weighted index struggling, but had a real nice week right up to that key yellow dash line. Risk monitor stays yellow right now. What would get the risk monitor, there's different scenarios, but as I was explaining, if the S&P were to sell off now to test but hold this second yellow line, right, and build a base between these two, the risk monitor will reset. And on the next leg out, we'll get risk monitor green, is my guess. I may not, but we could. Okay. So on the one hand, this is the daily picture. And I understand why we're all more bullish, because here's the weekly picture. That looks like a weekly breakout. That looks like a weekly breakout. Market just broke out. Even though it's still within that band, it looks like it's breaking the downtrend for sure. It's a weekly breakout. Okay. It would have been a lot cleaner had it closed at the highs, but it doesn't have to. It's actually pretty healthy to come out here, test, come back, maybe close the gap, come back, hold the uptrend, and then blow out next week. That would be great. Nothing wrong with that. But I would submit to you that it's a little too much too soon, right up to overhead, and there's going to have to be some work done in here, is what it looks like to me. Price action's all. If it blows out next week, I'm going to be on it. All right. So those are 2 of the 7. Let's go look at the Dow next. Okay. Now the Dow had it, and this is the problem with the market right now. The Dow overshot and led the whole market last quarter. And then it put in what looks like a serious top here, and it continues to churn underneath that top. So now let's look at the Dow and then scooch over to the small cap. Now small cap looks great, just blew out. But I think you can see as I go through this, so that looks great there, right? That looks like clear triple bottom right off the low, breaking out. Let's look at the Dow weekly. So the Dow weekly is building a pennant up here, a wedge. If it can confirm next week and break out with the rest of the market, now you've got something where there's more confluence. But what's happening right now is that the leadership, Dow, commodities, energy, these things have been suffering as the beat up names, and we can go take a look now at like the ARK fund, have been ripping off of the low. That's not even a big move, really, quite frankly. The ARK's just come off the lows there. Right up the 200-day moving average, and it kind of bounced its head up against the 200-day. So there's been a churn, a rotation in the market. And here's our IBD 50, which is the innovator index we like to watch, which is just god-awful, but has come off the lows. So you're starting to see a picture here, right? The equally weighted indexes are going to weight the names that got beat up and have ripped off the bottom. It's going to weight them more. So you're getting a breakout there. And the lumbering big caps are starting to come on, which has caused the market to pop here to the top of its channel that goes back to May. So we're at this key juncture without confluence. So what we're looking for now is consolidation in time or price that sets up the next entry for us to get really bullish. Or market breaks down from here. This is a bear market rally, and we go back down to the lows. I don't know which it's going to be. We have to read and react to what the price action tells us. Okay. So a couple backup indexes that we've added to what we're looking at. Here's mid caps, by the way, just in case you were curious. Here are the mid caps. I mean, it looks like a great breakout, right? Just boom, boom, boom. That looks great. And I hope it continues. Here's treasuries. This is also on our list, okay? Treasuries are important. You need to see treasuries go up, not down. So they got wrecked on Friday, and I'm going to get to precious metals in a second. And one thing that keeps me cautious on the market, other than the risk monitor yellow, is that the canaries in the coal mine, which are rates, which are assets that are most affected by strength in the US dollar, that are most affected by interest rates going up, had a pretty ugly week last week. Precious metals, treasuries. So are the canaries in the coal mine going to really collapse next week? This has been a market that's highly correlated. In other words, everything follows each other within a very short period of time. So if we got bonds breaking down, which they haven't done yet, I'm still long treasuries. Hopefully it holds up. But if treasuries break below the 50-day moving average next week, and the dollar continues to go up, let's go take a look at the dollar, which had a big day, okay? It's been a pretty impressive sell-off in the dollar. We called it right in here. We talked about how this was going to be bullish for precious metals, right? Okay. And then we had a big up day off the bottom. It's just one day. It's just one day. If it turns into 2, 3, and 4, then the market's going to have a problem. And that's what I want to highlight today. And I'll end this segment and we'll switch over to precious metals now. Any questions you have from this, just throw it into the comment section and I'll go over it with you as soon as I finish up my thoughts here. But the takeaway from this segment of the conversation, risk monitor stays yellow. Risk monitor only changes if we get a correction in time or price. Risk monitor yellow means we're willing to put money to work, but we use tighter stops and we swing trade things. We lean towards swing trading as opposed to investing. That's the big difference between yellow and green. Okay. The takeaway from this segment is while it looked real good, and I don't even want to argue. I'm not a bear. I'm happy to get more bullish. As we see weekly closes that were really strong, I'm concerned that there are some cracks in the armor, the canaries in the coal mine on Friday. The action Thursday and Friday in precious metals and in the dollar and in treasuries and in the bond market. We're going to go look at that now. Concerns me a little bit. Just for a second. If it gets uglier next week, it's going to concern me a lot more. So let's go take a look at precious metals now. We'll start with gold. Okay. That chart is as ugly as it gets. Now, I want to say this as loud and clear as I can. And if you have to go watch last week's video, go watch it again, because I said it many times last week. We sat down and had a heart-to-heart with the Silver Fox, an ARMR insider on our desk, near and dear to my heart. It's my dad, right? We've been working together for decades. We had a great macro conversation about where we think precious metals are going long term. But I said over and over and over again during that conversation that we manage risk and that we bought these assets cheap. I said to you last week and the week before and the week before that, we are not chasing the metals. We never chase the metals. The purpose of the conversation last week was to give you a picture, long-term macro picture. And now, what you've got to do as a portfolio manager, if you like that picture, find the way in on weakness. That's what you got to do if you've missed the move. Okay? So here's your weakness. It's coming. You're going to get your shot. We bought gold here. Double bottom off of the low. Excuse me, sorry. Okay? Double bottom off the low. It ran. No matter how much we love gold, the low of Fed day, which was immediately reversed. This down bar right here took out the low of Fed day. On that day, which was Thursday, we were booking profits on our move from November that we bought. We have an extra big position on from November. We sold it down to a core holding. Sorry, guys. Hang on a sec. Okay, we sold it down to a core holding. Okay, so the macro story we spoke about last week keeps us in a core holding of gold and silver. There's going to be wild swings along the way. We're going to trade around that core. So at the end of the day, Thursday, boom, we took off all the excess back to a core position. We put on a dust hedge. So we bought an inverse ETF of GDX. Okay. We bought dust Thursday. As you can see, the metal crashed on Friday. Same thing for silver. That inside out reversal bar made us book profits on any excess, right? So I still own a piece of silver and gold. But by the end of the day, Friday, I don't own any GDX, GDXJ, or SILJ. I'm 100% out of those positions. And we used dust. So we bought dust here on Thursday to hedge some of that risk. And I booked a profit in dust because I'm really only using dust to hedge overnight. So what I wanted to do was give my metal positions an extra day to see, okay, so instead of selling them, I bought dust to reduce my exposure so I could deal with whatever happened on Friday. And when it collapsed Friday, boom, made money in dust. Took the hedge off, making money there, paying for some of the risk in my portfolio. I didn't have it hedged 1-to-1, so I still lost some money on Friday, but hedged off probably about half the position. So made money there, closed out the exposure. So all I have now in ARMR portfolios is a core holding of physical. My intention now is to increase that core holding again the next time the ARMR algos give us a risk on entry point. This is the only way to make money in metals. You cannot chase gold and silver. You have to buy them when they've been crushed and nobody cares about them. The minute you start seeing people on CNBC tell you how high gold is going, you start looking at your stops and raising them. Price action is all. It doesn't matter how much I love the macro story. When gold and silver reversed on Thursday, we knew that a reversal was unfolding and we had to protect capital. And so that's what we did. The bigger picture to me is, I don't want to spend a second, ladies and gentlemen, a second talking about conspiracy theories and short sellers and how they suppress gold. That doesn't make me any money. That's just a bunch of excuses on why metals go down. And it's conspiracy theory. Maybe it's true. Some conspiracy theories are true. I only want to spend time at the ARMR Report on this desk and on my live stream every day. We go from 9:30 to 4 every day. Sharing screens, sharing algorithmic information, sharing fundamental information, trading together. ARMR Report right there. Join us if you want. ARMRreport.com. I don't want to spend a second trying to figure out why something happened. I don't care. Algorithmic execution, stop loss discipline, execute the strategy, move on. The next time gold and silver set up a buying opportunity, I'm going to be there. It's not hard. We were there in November. We'll get another setup now. When we get it, we'll be there. The bigger question to me is this just a shaking of the tree of precious metals? Or because these are most sensitive to the US dollar strength, is there a move coming higher in the dollar? If that's the case, then I submit to you, the stock market is not going a lot higher right now. And we will get our consolidation in price for the equity markets going forward. If that happens, okay? This is not just like a 2-day collapse on an insane non-farm payroll number, right? That number was bigger than anything on anybody on Wall Street expected. Total blowout. In fact, I even saw that the birth-death model reduced the number by 144,000. So non-farm payroll came in above 500,000, and the birth-death model, which is usually the thing that makes the number come in big, actually reduced the number by 144,000. So it would have been an even bigger number. Okay? Let's go see if this is an issue. Okay, here's treasuries. If they break below the 50-day moving average, it's an issue. It means rates are going up. Let's go look at high yield bonds, junk bonds. Junk bonds have broken out and left at the moment. This is like a little evening star if you're a candlestick chart and analyst, right? You break above a key resistance area with a gap up, and then you immediately gap down. That's generally a very bearish sign, and you would expect lower prices. Stocks follow bonds. Don't forget that, guys. Here's investment grade bonds, a break out above the 200-day and a collapse back below it. All right. So I'm going to end on that note. I have to go to, I promised a couple of, okay, so let's just get bullish, and then if there's any questions, I'll answer them. Then I have to get to our macro meeting. So ARMR insiders who are joining me for this, don't forget, go to the Slack room right now. Michelle has put in there our Zoom video link, so you can click on it, boom, go to the Zoom video. Maybe we'll start at around, 12:10 or something. Let's just answer a couple questions here and go over some more charts, and then we'll start our macro meeting. For ARMR Insider, any ARMR Insider at any level of subscription, you're welcome and invited into the macro meeting. So just reach out, armorreport.com. You can go in there and find your way to it, or send an email to Michelle, and she'll give you the link to our Zoom meeting. Okay, so that's ARMR Lite, and ARMR Pro. You guys can all join us. So before I go, I'm painting what is a cautious picture of the market based on price action and the interaction of markets, okay? So we have to see what unfolds next week. Break down further in the metals, a breakout further in the dollar, a breakdown in the bond market is all a dangerous sign for equities, which are right up against the overhead and that key area. At this point, I would have, maybe the question also maybe, when would it go risk monitor red? I'll tell you, at this point, I would have all of my stops raised to the low of Fed day. This is what we did with precious metals. On Thursday, it took out the low of Fed day. We were booking profits and putting on hedges. If the market takes out the low of Fed day, what I have right now is all of my positions with stops elevated. If the market takes out the low of Fed day, chances are all my positions will be getting stopped out because I have high stops now. If the market wants to keep pressing higher, I'll hold the positions. If they take out those stops, I'm gone. So if the indexes take out the low of Fed day, chances are, I can't guarantee it's an algorithm, I have to go look, but chances are the risk monitor may be turning red. I don't know. I'll keep you informed. So anyway, all right. So there's the bearish picture. Let's swap over real quick. I'm going to share with you the chart pattern that's making us money. And so these are stocks that are on the top of our whiteboard or in portfolios already. So full disclosure, we may already own it, but this is for you to do research on. This is a moment to share with you what's on our whiteboard, and then for you to figure out if it fits into your risk tolerance and goals. So we added Etsy last week. That's just a perfect pattern breakout. Stock held up fairly well in the tough market of Friday. And let's take a look at the O'Neill chart too. Here, there's Microsoft. I got Microsoft on the list. I'm considering Microsoft. It's trading in a range right now. I wouldn't do that in front of earnings, that's for sure. But it's getting me interested because of its AI involvement with chat GPT. We'll get into that right now. Here's Etsy. All right, that's just coming off a bottom. This is the pattern that's really working for us. I'll share with you, I think I have on other videos, Disney, right? We bought Disney right off the low here on the double bottom. It's broken out above the 200-day. Okay, so we're looking for patterns like that. Fibonacci fan sequences, which means we need a big downtrend. We're looking for charts in the bottom right-hand quadrant of the screen, breaking double bottoms, breaking downtrend lines, algorithmic entry point using our algos. Okay, we added shares of Uber. What a great day Uber had. We added Uber right in here. We actually added Uber pretty cheap. And so, again, what I'm trying to do in this market, which is not easy, is when we get that algo entry point, we get a position on quick, right? Try to buy it in the base right before it breaks out. But really what we're trying to do is buy it closest to the stop. So we owned it right in here. It consolidated and blew out last week. This is one of my favorite patterns, Uber. There's the downtrend. Breaking into the downtrend, pennant formation, bottoming wedge, breakout. That looks phenomenal. And Uber and Airbnb tend to run together. It's really weird, and maybe not. People use them both at the same time. Okay, this looks like Disney's pattern. So I paid up for it. I didn't buy it down here when I should have. I actually paid up for it last week. As long as it stays above the 200-day, I'll stay with it. But the 200-day is my stop. So it comes back below and I'm out. I'm a little bit late there. I still have my eye on the biotechs. I think the biotechs are building a really solid base. And if we already have a position, and if it breaks out, let's say above 140 on IBB, I'll probably increase my position size. And then XBI looks really good coming off of that level. We bought that right here and it continues to grind higher. I'd like to own a little more of that. So as much as I love Trade Desk, we actually booked a profit on this. We bought it here. It popped up and reversed on Friday. We booked the profit. And my other favorite name in that ilk is GitLabs. We bought it here. It popped up, reversed Friday. We booked a profit. Now, normally I wouldn't do that. Okay. I'm going to end on that note, take a couple quick questions. I normally wouldn't sell it right away, but I'm concerned when the risk monitor is yellow. I want to make sure that I'm protecting capital. And if something comes back down towards an elevated stop, I'm booking profits. So when I'm swing trading and I buy something like GitLabs and it pops, I raise my stop to break even or a little bit higher than break even. And if it comes back down to it, I'm taking positions off and booking some profits. And then I'll wait and see. if GitLabs makes a nice pennant up here, I'll buy it back. If the market's able to advance next week and take out the highs, I might buy it back. But Friday at the close didn't like the action, so I raised cash here and booked profits. Okay. All right. I got to get to questions and then I got to split on you guys. What do we got here? Thanks, Ray. Actually, I am feeling better. However bad it sounds right now, I'm actually better than I was. S&P's price action from September 2nd and 6th compared to Thursday, Friday of this week. September 2nd. I think you're talking about right in here. So it had this nice big up run and then just imploded. Maybe that's what you're referring to. I kind of look back right over here where we had this breakout above this yellow line. So it looked like the market was going to get going and then it immediately crashed back below it. You know, but I hear what you're saying. Stephen, how are you, man? Petrodollar. Yeah, we did well in the gold trade, Stephen, and that's, Stephen's an ARMR insider, and so we were buying it cheap and we booked a profit on it. Petrodollar. Do me a favor, Stephen. Let's talk about that because I know you're going to switch over to the we can go more in depth. I'm assuming you have time to hop over to the macro call. But well, the petrodollar, what does that really mean? I mean, that's like, I can't answer that question quickly. But I could say this: the world trades energy in dollars. Okay, and that has been going on for decades, and that's one reason, arguably, that the U.S. is so dominant. And so China, Russia, Iran, these other countries would like to get people off of the petrodollar. So would you trade a barrel of oil in a basket of currencies? They've been working on that for a while. So the theory is if the petrodollar ever breaks, in other words, if energy is traded in other assets and it's not as the U.S. dollar is not as necessary, it would lead to a long secular decline in the U.S. dollar. It's only this strong against all of the currencies theoretically because it's the world currency. It's what's used all over the world. And if that changed, but that's a big picture macro thing that takes a lot of time. People have been talking about the end of the petrodollar probably since the petrodollar got started. So it doesn't help me make any money, UUP is a basket of currencies against the dollar. So we watch UUP because it shows us how the dollar is doing against a basket of other currencies. Okay, if you get a chance, take a look and we'll see if it plays out with small rally. We just wanted to give you a look at something to check out. I got you. Talking about buying PAMs on Monday on CNBC, right? Dennis, the minute they start talking about buying precious metals, you can't buy it. You don't sell it right away, but you can't buy it. And let me tell you something, Dennis, and everybody watching this. When we were buying precious metals in November, they were talking about how gold is a barbarous relic on CNBC. No, I'm just going to drop. Nope, Mike just dropped. Let's move on. They didn't jinx us, man. They don't jinx us. They gave us a heads up. Time to book profits and go to the sidelines. Wait for the next setup. Yeah, Uber looks great. Path looks great. I'm still working on that. And I'm not sharing that chart right now. Uh, 15-minute or hourly. I'm not sure what chart you're looking at. And I'll take that last question, but this is a daily chart that we're looking at right here. So I'm not exactly sure what you mean there. All right, guys. Oh, hang on a second. Hello? Will do. This is my producer calling. And we got to end the show right now. I'll see you guys next week. And ARMR Insiders, let's swap over to the macro meeting right now. Have a great weekend, everybody. Take care.